Give a few more seconds for those that are streaming in. Welcome to everybody. Okay. Well, good afternoon, good evening, good morning, depending on what day you're watching this, whether it's live or recording later on. My name is Chris Purnell with CRI Cape and Krause, and this is a presentation on accountable expense reimbursement plans. So if you were looking for something different, maybe your favorite streaming show or something else, sorry to disappoint you. This is not that. Although, to my opinion, accountable expense reimbursement plans are some of the most scintillating things to discuss, and they are certainly near and dear to my heart. So hopefully you get a sense for how important these things are and what they might mean to your ministry, your nonprofit, your organization more generally. So this is reimbursement plans done right, mastering expense reimbursements in the nonprofit world. You may be thinking to yourself, holy smokes, that is quite a title. How dare you? The hubris mastering expense reimbursement plans done right. But hopefully by the end of this hour-long CPE eligible presentation, you'll begin to see that while there are some nuances and permutations and different things that are hard to discern in the world of things that can be reimbursed on a pre-tax basis, we'll do as much as we can, and you'll walk away with a greater sense of confidence knowing what to do with your organization. So, speaking of CPE eligibility, continuing professional education is offered for this webinar at 1 credit for the taxes field of study. So you get 1 credit hour for 50 minutes in attendance, but I will be speaking for the entirety of the hour. There is no partial CPE credit for this webinar, so you either get 1 credit hour or you get none. So please log in with your unique link sent to your registration email. Stay logged in for the entirety of the webinar to ensure, number one, you get the content. Number two, that you don't hurt my feelings. And number three, that you receive your CPE credit. You must answer a minimum of 3 polling questions, and then log attendance for a minimum of 50 minutes. Correct responses are not required. In fact, that is the best way to learn, is by getting a wrong answer and then being corrected. So dive in with gusto and be sure to answer 3 questions at least. We do offer 4 polling questions just in case you miss one of them. Then certificates will be distributed within 7 days of the virtual event to your registration email. Any questions that you might have, if you have them right now, you can drop those in the Q&A section. If you have some afterwards, you can email marketing@criadv.com. A CPE survey will be available in the web browser immediately following the webinar. And last but not least, PDF handouts of the slides are accessible for download through the Zoom chat and will be posted to criadv.com following the conclusion of this live webinar. So with that, let's talk about what in the world we are doing for the next hour or so. Accountable expense reimbursement plans, they are essential in helping nonprofits reimburse employees and leaders in a compliant, tax-efficient manner. So this webinar is going to be a review of IRS requirements, pitfalls in nonprofit settings, and nuanced issues as ministry-related expenses, mixed-use costs, and documentation challenges. So this is designed for accounting professionals, nonprofit finance leaders, and is hopefully going to give you some things to think about with regard to real-world application. This is not just going to be an academic exercise, as awesome as that is, but rather it's meant to be practical and of utility to you in your nonprofit. So what are the learning objectives? Number 1, identifying IRS requirements for accountable plans, including substantiation, business connection, timely return of excess advances. Number 2, to evaluate common compliance risks and errors. And then number 3, apply best practices to design, implement, and maintain accountable plans that align with nonprofit governance, internal controls, and audit expectations. Gonna take a breath here before we jump into what is actually on our agenda substantively. We have 5 stops along the way for our journey through accountable expense reimbursement plans. The first one is the reason for accountable plans. You may think to yourself, hey, Chris, I don't need reasons. I don't need all of this philosophical gobbledygook. I just need some practical utilitarian plans, and I need to know some of the risks associated with particular expenses. Well, I get you. I understand that. Sometimes it's helpful to think through the why before you jump into the what. So we will do a little bit of the why work. And then number two, the substance of accountable plans. What is included in an accountable expense reimbursement plan? Number three, various scenarios where we will, you guessed it, run through various scenarios that will oftentimes pop up with accountable expense reimbursement plans. Number four, practical steps to consider, which is going to be fairly short, but my hope is that this will be helpful to you in the creation or fine tuning of your plan. And then last but not least, if time permits, we will have a time to answer questions. So with that, let's meet your presenters. And by presenters, I mean this guy. So, hey, Chris Purnell, tax counsel, Cape and Krause, partner at CRI Advisors LLC, partner at CRI Cape and Krause Advisors LLC. So you might be thinking to yourself, hey, do you have 3 jobs? And the answer is, well, sort of. I am a husband and father and a partner at CRI Cape and Krause, but really I just have one job. But this slide makes it seem like I got 3. I got 3, but I really don't. So that's me. With that, let's jump into the reason for accountable plans. The first and probably most well-known reason for an accountable expense reimbursement plan is you want to avoid inclusion in gross income, or rather your employees want to avoid having these expense reimbursements included in their gross income. So the Internal Revenue Code, aka the Bible for tax professionals, says this in section 451: the amount of any item of gross income shall be included in the gross income for the taxable year in which received by the taxpayer, unless there's some particular exclusion. So what this means is that there's always a ghost. There's the specter of inclusion in gross income that hovers over all of these items that you as an employer may pay for an employee, whether it's meals, mileage reimbursement, travel more generally, that there's always the possibility that these could be included in gross income. And in fact, if you reimburse an employee and it's not underneath an accountable plan, then you are required to include it in their gross income. So where do I get that? Well, I'll tell you where I get that on the slide. So this is from IRS publication 5137, which is it's also kind of drawing from the Internal Revenue Code, but just for the sake of some variety, I drew this from 5137. It says this: under an accountable plan, allowances or reimbursements paid to employees for job-related expenses are excluded from wages and are not subject to withholding. What a beautiful word, excluded from gross income. And that's how you make sure that those expense reimbursements are not included in the employee's gross income. So reimbursement under an accountable plan, what it's doing here is it's making sure that those items are not taxed if indeed they are for business-connected expenses. So that's reason numero uno. Are there other reasons? Well, you betcha. You betcha. But these, depending on your station in the particular organization, you care about these to a greater or lesser extent. I care about them all. It's like asking me to name my favorite child. Can I do it? Yes. I'm just kidding. Just kidding. I can't do it. But it's kind of like asking you to do that. I love all these reasons. These are all really good reasons. So the next reason that we will discuss is governance and fiduciary considerations. Governance and fiduciary considerations. So what are we talking about here? Well, if you have an accountable expense reimbursement plan and you're reimbursing your employees for various business-connected, ministry-connected, organizationally connected expenses, then what that does is it signals to whoever outside observers might be, whether they're just kind of run-of-the-mill constituents, donors, foundations, other funders, et cetera, or maybe even governmental authorities, such as the IRS, if you ever get audited by them. Basically, what it signals to them is that you have an understanding of the importance of stewardship and accountability for using the funds that have been entrusted to you as an organization, as a nonprofit organization. Because you see, the IRS thinks, and not without warrant, but the IRS believes that it has subsidized the funds that have come to you because usually those funds are tax-deductible contributions from donors. And you're not taxed. So the IRS feels like, hey, you're not paying tax unless it's on an unrelated business. And the people that make contributions to you, they get a chance to deduct if they otherwise qualify for those itemized deductions. So they see that as a sign that they have subsidized those dollars. Those are public dollars. And then number two, if you can demonstrate a cadence of like review, documentation, approval, it does happen to bring great joy to the heart of various constituents. I am not only a person who was a fundraiser and an executive director of a nonprofit, what feels like many years ago, depending on how old you are, that was 6 years ago, 7 years ago. Whoa, time flies. But also, I'm a donor to organizations, and we like to see things like this kind of approval mechanism and using the funds entrusted to you in a way that's compliant. Well, here's another reason: private inurement and excess benefit. So, accountable plans, what they do is they help protect against the possibility of private inurement and excess benefit transactions more generally. So, private inurement, basically, what that means is that those who are insiders or quote unquote disqualified persons, think about people who have substantial influence over your organization, board members, and that sort of thing. They get some kind of outsized benefit that is beyond just compensation for services rendered. So you can help avoid that kind of business through having an accountable expense reimbursement plan because it gets flagged through your accountable process. It's a hot water space for sure. Undocumented and loosely controlled reimbursements can look like disguised compensation or personal benefits. There might be a private benefit, even if they're not an insider or disqualified person, a person of substantial influence. There can be the possibility of excess benefit transactions there, which can land you in hot water with the IRS with regard to taxation and excise taxes, and there's all kinds of stuff there. Reimbursement under an accountable plan, it helps to establish that the reimbursements are legitimate and it's not just disguised compensation. Because remember, you're trying to avoid inclusion and gross income, and so therefore, if it's just disguised compensation, then it could get transformed into compensation. Equality of treatment. So whether you come from a large organization or a small organization, you are in the United States of America, and we care about like being treated alike. We're getting ready to celebrate, or hopefully you are celebrating this entire year, the 250th anniversary of the Declaration of Independence, that all men are created equal. So therefore, in your organization, you should make sure that like is treated alike, that people are treated equally. But not only that, not just for the purposes of honoring the founders, but also for the purposes of if you got an executive director or someone in the C-suite of your organization, and they might have a tilt towards the good for thee, but not for me, unspoken rule, where maybe they don't actually follow the accountable expense reimbursement plan, or maybe they feel like the rules don't really apply to them, then actually utilizing a plan and monitoring it and policing it can be a really healthy thing for an organization. So yes, honor the founders in this great year of the semi-sesquicentennial, but also make sure that your people in your C-suite, your leadership, are being treated just like anyone else with regard to the accountable expense reimbursement plan. We'll talk more about some of the complicating factors of that near the end of the presentation. And then last but not least, I would be remiss if I didn't bring up preventing fraud, preventing abuse. Now, I get it. Anytime I drop the F-bomb of fraud during a conversation, it really has a tension. It really has a tendency, rather, to cause things to get awkward. And so I'm completely sensitive to that. But just know that an accountable expense reimbursement plan that's actually policed and monitored and used can be something that discourages fraud and abuse because chances are it's getting reviewed by someone to determine whether that's actually personal spending that you're trying to expense as a business-connected reimbursement. You got to watch for duplicate reimbursements, inflated expenses, and that sort of thing. If these things just kind of slide, right, and usually it's paired with that last slide where it's good for thee but not for me sort of culture, this can lead to a culture that is ripe for fraudulent activity. And simply knowing that someone might be reviewing an expense reimbursement request can be enough to deter many cases of fraud. Not all, but many. So speaking of fraud, again, I got a couple slides here. This is my good friend, fellow partner, Nathan Salisbury, who, by the way, he delivered a dynamite lecture on this in a conference that I was present at, and an hour and a half talking about these findings from his fraud survey. And I will tell you, I did not fall asleep once, not even once, which is impressive because I'm a sleepy dude. But anyway, Nathan did some doctoral research regarding how are faith-based nonprofits, because that's the sea we swim in, that's the air we breathe. But how are faith-based nonprofits trying to navigate best practices with regard to fraud prevention? And he had over 400 respondents, and it assessed various aspects of their understanding of their risk of fraud and other elements. And here's the fraud triangle for your review: the pressure / incentive to engage in fraudulent activity, i.e., finances are really tough. I can't make my mortgage payment, fill in the blank. Number 2, rationalization. We creatures, we humans, we got an inner lawyer that is just nonstop. I can rationalize pretty much anything, but justification of the dishonest actions. And then number 3, opportunity. An organization like yours cannot do a whole lot about the pressure incentive and probably can't do a whole lot about the ability of that employee to rationalize bad behavior. However, you can do something about the opportunity. So to that end, one of the questions that Nathan asked in his survey was, not considering internal controls in place within your organization, what asset misappropriation schemes do you think have the highest inherent risk of fraud within your organization? Then choose all that may apply. And you'll see there it's highlighted: expense reimbursements and credit cards. And that, my friends, comprise 71% of the total responses. 71%. So if you're looking for an arena in your organization where you can just it's easy picking as far as what can we do to limit our risk of fraudulent activity, you could do a whole lot worse than looking at the expense reimbursement and credit card space. All right, so that's a little commercial for the fraudulent activity and how to prevent it. So now that we've talked about the why, let's move on to our first CPE question. And I'm going to launch this poll for you. And here's the question. All the following are reasons for creating and following an accountable expense reimbursement plan, except number 1 is a good fraud prevention tool. Number 2 is a good governance and accountability tool. Number 3 is required in order to ensure that employee expenditures are not included in their gross income. And number 4, the IRS requires that you have one in order to be considered a tax-exempt organization. So I'll leave this up there for a little bit. I'm going to check to see if we have any questions in the question and answer box. There are none. Seeing a lot of responses coming in. This is good. From what I can tell, you guys are killing it. Good job. All right, we got some comments and questions. If you want to have a very disheartening, a very disheartening Google search, just type in fraud current in Google, and many responses will pop up. I've got one from Bob Castle. Let's see here. Bob, I might respond to you offline if that's okay. And get to your question then. So by the way, just so you guys know, if I don't get to your question during the actual presentation, which, the likelihood of me getting into it is pretty slim. But if I don't get to it, then I'll go ahead and send a response via email. So that way your question does get answered. And some of these, if they're a little bit more in the weeds with your particular organization, I might not address it. So, Bob, there's no hard feelings, um, at least on my side. But I'll get to your question via email. Appreciate you. All right, I'm going to end the poll. And the correct response to the poll question was number 4, the IRS requires that you have one in order to be considered a tax-exempt organization. Indeed, the IRS does not require that you have an accountable expense reimbursement plan in order to be considered a tax-exempt organization. They ask about other policies and that sort of thing on the Form 1023 to be recognized. The big one there is a conflict of interest policy. But then on the 990, they ask about others. But no, the IRS does not require that you have a accountable expense reimbursement plan. All right, let's keep going. Let's keep going. We got a lot of ground to cover. So much to do, so little time. Let's move on to the substance of accountable plans. And I will tell you that accountable plan requirements, they're not numerous. There's literally 3. There's literally 3. Which means that you could spend a lot of time talking about all 3 of those. And really, there's one that that I will constantly get called about, emailed about, asked about, and a lot of the different permutations of the nuanced questions of what's something that can be reimbursed on a pre-tax basis and what's not will hover around one of these particular factors. But I want to home in on one particular thing on this slide, and that's right smack dab in the middle. An accountable plan does not need to be written, though for reference purposes, it should be. It should be. So you may be thinking to yourself, hey, Chris, we don't have an actual written plan, but we all just kind of know what should be expensed, what can't be expensed, that sort of thing. And I get that. I get that. You can be a little bit more of an informal organization if you're much, 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 much smaller. Although even for that case, I would say you probably still want to have it written down. But it's not a requirement of the accountable expense reimbursement plan itself, at least in the eyes of the IRS. Now, if the IRS were somehow auditing you for some other reason and they asked for your accountable expense reimbursement plan, you're like, let me just have a conversation with you. That is kind of difficult, right? You probably want to have something for that purpose, but purely from a compliance perspective, it's not required. Though we strongly recommend that it be written down and published for all of your employees, so that way they know how the process works. So, what are the characteristics of an accountable expense reimbursement plan? Well, it has 3, as mentioned before. Number 1, the reimbursed expenditure is required to have a business connection. A business connection. And by the way, these 3 are kind of items, just so you know. But yeah, if it does not have a business connection, if this is purely a personal expense, then chances are it should not be expensed on a pre-tax basis. That is a taxable expenditure. So one of the requirements of an accountable plan is that it must require that expenditures have a business connection. Okay. Number 2. An adequate accounting for the reimbursed expenditure should be provided within a, quote, reasonable period of time. Now, when I woke up this morning and I was doing my hair, brushing my teeth and looking in the mirror, and I was like, Chris Purnell, you are one reasonable dude. You're one reasonable dude. Although those of you listening on the webinar right now might have a penchant toward disagreeing with that. But we all probably think we have a sense of what's reasonable and what's not. For those of you who are lawyers in the audience or no lawyers or, have the misfortune of being married to one. By the way, my wife is married to a lawyer. And and today is our 21st anniversary. So congratulations to her. She is long suffering. So adequate accounting within a reasonable period of time. We'll talk more about in then slides to come. And then last but not least, if you're an organization that does advances, meaning that you have an outlay of cash to an employee for a particular expenditure before the expenditure takes place, then those excess advances, meaning they don't actually expend the entirety of the amount that was advanced on the expenditure that was agreed upon, those must be returned within a, you guessed it, reasonable period of time. And we'll talk about what reasonable could look like in your organization in the slides to come, because the IRS helpfully, the Treasury has provided safe harbors for how long a reasonable period of time is. So what's What's required substantiation? Well, the stuff you'd think about, right? Something that shows the time, date, place, amount, and the really importantly, business purpose of the expense. So you really have to get that expense into a primarily business purpose space. Okay. So if this is something where it's on either the knife's edge of, well, I could spend it on it's kind of personal, but it's also kind of business. Err on the side of considering that a personal expenditure, and therefore either A, don't reimburse it, or B, consider it taxable. But it should have documentation regarding the time, date, place, amount, and the business purpose of the expense. You're looking at things like bills, receipts, canceled checks, or other types of items. Whenever I go to dinner or lunch with one of my fellow partners, and we're taking out a prospect or something like that, and he's paying for the lunch. He's writing down who was present at the lunch, what was the purpose of the lunch, and then making sure that gets logged into our platform of choice for expense reimbursement plan, Concur. I get it. There are others, but that's what we choose to use at CRI Cape and Krause Advisors LLC. But that's the idea. Something written down, some kind of formalized documentation that shows time, place, date, amount, business purpose. And if you need to doctor it up by writing on it and saying what the business purpose was, that's always helpful. So we talked about reasonability and how when each of us looks in the mirror, we see a reasonable person staring right back at us. Well, you can use a facts and circumstances test, which in the eyes of the IRS is, you can bring all the different things to play and show why your methodology is considered reasonable. However, in the absence of that, the IRS in the regulations provides a 60-day safe harbor, 60 days. So if you require that the employee submit adequate substantiation of that reimbursable expense within 60 days, then you would fall into the safe harbor, and that would be considered an aspect of an accountable plan. So 60 days is kind of a magic number. And my suspicion is if your organization has an accountable expense reimbursement plan, it probably uses the 60-day safe harbor. Now we're kind of in it. What is a business connection? What is a business connection? Well, I'm going to read this slide to you, and then I'm going to spend a little time unpacking it. So it's a business connection. It's those expenses that are incurred in connection with the performance of services as an employee that would otherwise be deductible as ordinary and necessary business expenses under Internal Revenue Code Section 162. These should not be amounts that would otherwise have paid as wages. So remember, we're not looking for disguised compensation. Rather, we're looking for those expenditures that would really be necessary in order to carry out the business purposes of the organization. So you're looking for an element of necessity. You're looking for a strong element that these are not otherwise personal expenses, which can get tricky in nonprofit organizations and in ministries more particularly. So those are the kinds of things you got to watch. You're looking for necessary. You're not looking for anything extraordinary, ordinary and necessary. And number three, you're looking for a strong sense of this is for the organization, not personal expenditures. So with that, we've talked about an accountable expense reimbursement plan. We're now going to move on to our second polling question, which is this. All the following are required elements of an accountable plan, except number one, the plan must be written. Number two, it must require a business connection to the expense. Number three, it must require adequate accounting within a reasonable period of time. And then number four, it must require the return of excess advances within a reasonable period of time. We'll let these responses flow in. Got a question in the Q&A that since we got a few seconds here, I'll just reflect on for a few seconds. David asks, suppose we pay the airfare for a major donor to join a guided tour to visit one of our ministry sites overseas. Is this a taxable benefit for the donor? And the answer is when you're dealing with donors, you're kind of straddling a few different realms. The first one is, could this be considered more akin to a quid pro quo contribution? So if the donor makes a contribution and then you decide, okay, well, as part of that contribution, we're going to pay for your trip overseas and other expenses that might arise. Well, it seems to be a pretty clear case of quid pro quo contribution. You're giving them benefits, services, that sort of thing, and they're giving you a contribution in exchange for that. Order may matter. This is where it gets a little squirrely. If they give you a disinterested gift and then 6 months later you're like, hey, surprise, we want to send you overseas. Well, then that's a little bit different, right? That's not really seeming like it's in exchange for the contribution or in exchange for the goods or services that are given. So something to look out for. So it could be a quid pro quo contribution. If they're a board member, then you really have to watch those kinds of trips because that will most likely be considered taxable. They're providing services to you as a board member. You're giving them this benefits that could be taxable to them. But the shorter answer is it depends. Would love to chat more, but it could be a quid pro quo contribution. Happy anniversary. Thank you, Galen. I appreciate that. What would you consider a subscription for things like Peacock TV streaming? There's assumption that they use for events. That's really interesting. I hadn't even thought about streaming services. The short answer is maybe. I suppose there's a world where streaming could be for a business purpose, but you need to watch to see, who's the account under, what's the actual usage that's taking place. If like they use it for one event a year, but you see that there's been 1,000 hours of viewership, is that really a business connection? Is that really not a personal use? So there's a lot of things to think about there. But the answer is maybe, which by the way, I know that lawyers and accountants get a bad rap for saying words like maybe and it depends, but it does depend. It does. So, what is the right answer on this question? All the following are required elements of an accountable plan, except number one, the plan must be written. It need not be written. Is it a really good idea for it to be written? It sure is. It sure is. So we heartily and without reservation recommend that it be written down and published for your employees. So a couple of things that are just miscellaneous issues before we jump into our various scenarios. What do you do when you have credit cards that are out there? Your employees are using credit cards that are in the name of the ministry or the nonprofit, and you're not getting adequate substantiation. Because one of the things that is a nice incentive when an employee is forced to use their own personal credit card and then submit for reimbursement after the fact is, holy smokes, the incentive for them to get adequate substantiation into you is very strong. It's very strong. But whenever they're using the company credit card, the incentive dies down just a little bit. Now, I have heard tell of different platforms where it will shut down the credit card usage after, I think, 3 warnings. I don't hate that. I think that's a pretty good idea. I've heard of some organizations that just say, hey, we're going to give you 2 warnings. And then the third email will say, congratulations, you have extra taxable income. That I feel like is a little less preferable because then you might have to back it out. If they do give you the adequate substantiation within a reasonable period of time, or, just because of the kindness of your heart, you decide to. But I think that the 3 strikes and then credit card no longer works is probably one of the best ways to handle it. So I think that's good. Expenditure amount that needs substantiation. So the rule here is it's $75 or more. I would not recommend telling employees that. I would recommend saying everything. But $75 or more. Now, special validation, this is related to that. Are there amounts beyond which it's going to require dual signature, or it goes up to the board or finance committee? I think that there's a lot of wisdom to that. There's a lot of wisdom to that. Now, this is assuming that this is all within budget, right? If it's something that's outside of budget, like an extra budgetary expenditure, it's something that's not been planned for the year, then that's got its own kind of track, right? But if this is just something that's kind of large, then there's probably some wisdom in saying, for instance, $500 or less, it can just go through the normal channels. If it's more than $500, it's got to go through some special channels, something like that. And then last one on this slide, which expenditures are, or which employees rather, are approving the expenditures. This one is really key, especially for fraud prevention. If you have someone who is like an executive director or CEO or in the C-suite, and the person that's approving their expenditures is someone who's below them on the org chart, that is not necessarily wrong, but it does lead to some complexification, especially with those kinds of relationships. Now, if it's people that are kind of on the same level, CEO, CFO, that kind of stuff, then I suppose that could work. But even then, the CEO can hire and then fire the CFO, most likely. And so when you have those kinds of power dynamics at play, it does make it somewhat difficult for that person that's below the other person to call them on the carpet, or at least have a hard conversation regarding what they've submitted a reimbursement for. So you want to keep those kinds of things in mind, those kinds of dynamics in play. If I were in that seat, I would say that the executive director / CEO should submit their reimbursements to someone on the finance committee of the board, maybe the treasurer. But I get it. That can be difficult. But to my mind, it's kind of a better case scenario to do it that way than anything else. So with that, we're going to move on to our various scenarios. And here's what they are. Cars. Vehicles can be tricky as far as what kinds of things are reimbursable on a pre-tax basis and the things that are not. So we're going to run through some scenarios on that. Number 2, spousal and dependent travel. This is assuming that you have an employee who wants to bring spouse and or dependent along with them on some kind of business-related travel. Is that going to be considered taxable income to the employee or not? And the answer is most likely yes. Yes. Well, now I just spoiled everything, but we'll get into some of the details and the finer points in a later slide. Personal versus business use. Man, this is where things can get really tricky, and organizations can kind of bend over backwards and trying to figure out, is this more of a business use or personal use and that sort of thing. The mixed use problem, if you will. We'll talk about that. And then last but not least, just food. Food. Crime in Italy. The food expenditures have gone through the roof, not only because a Big Mac on the West Coast costs approximately $78, but also because we have a tendency to have a lot of business meetings out at restaurants. We like to eat. I've got a colleague who talks about how some people eat to live. He lives to eat. I can attest to that. It is a true statement. I also would find myself in that camp of living to eat. Food is great, but it does lead to some nuanced issues within the accountable expense reimbursement plan realm. So we'll talk about some of those. Car expenses. 3 sub issues here. Number 1, commuting versus transportation. Number 2, your methodological choices with regard to reimbursement. And then number 3, company-owned vehicles. Some intricate questions there. So I've got a diagram here from IRS publication 463, which, by the way, IRS publication 463 is a great publication for discussing travel expenses. And that's kind of where the car expenses are nestled underneath that, transportation expenses more particularly. So car expenses, what is commuting? What is a transportation expense that can be reimbursed on a pre-tax basis? Get a nice little diagram here that talks about temporary work locations, regular work locations, a second job, and then home. My hope is that this diagram is helpful, but sometimes it's not. But here is a good summation. Travel from your home to your principal place of business is commuting, which means that it is not reimbursable on a pre-tax basis. If your employer reimburses you for that travel, it is taxable income. Okay, so that's number 1. Traveling, however, between a temporary work location in another temporary work location or a temporary work location and your regular work location is reimbursable. But my suspicion is that the big questions that arise with regard to transportation hover around the, hey, my office is in my home. I am a remote worker. And so therefore, what does my reimbursability look like with regard to car transportation? And it's an excellent question. If you take a look at IRS publication 463, it has a subsection called Office in the Home on page 19. And then that will direct you to IRS publication 587. So a nice little breadcrumb trail from one publication to another. And that's where you do the analysis to determine whether your home qualifies as a, quote, principal place of business. If your home does indeed qualify as a principal place of business, then from your principal place of business to potentially, the home office or other places, or to visit clients or to visit donors, from your home to the donor place could be considered a transportation expense that is reimbursable on a pre-tax basis. But you really have to determine whether your home qualifies as a principal place of business. Internal Revenue Code Section 280A C1 is a good place to start. If you have particular questions related to this, feel free to reach out. Happy to chat. But again, this can get kind of nuanced, but that principal place of business analysis is really going to be important. Some things to remember. Number one, reimbursement of community expenses, taxable income. Number two, mileage reimbursement rates, the standard mileage rate, as the IRS calls it. It adjusts annually, currently set at 72.5 cents per mile. And that's from IRS Notice 2026-10. It's going to be interesting to see what happens with gas prices and that sort of thing over the course of the rest of this year. We could see another jump in the mileage reimbursement rate, especially considering that inflation. We had some interesting inflationary numbers, so time will tell. And then last but not least, the reimbursement rate and deductibility rate for volunteer service is 14 cents per mile. Now, you may be thinking to yourself, hey, Chris, that's really low. And yes, that's my response. Yes, it is low. But that's because that is enshrined in the Internal Revenue Code, that amount of 14 cents per mile. And so the IRS has its hands tied. It does not get adjusted with inflation via IRS notice on an annual basis. Congress needs to act. Now, if you've been watching the news lately, you know that Congress acting is a dicey proposition. But some ideas have been put forward, some bills have been floated, but nothing has really taken hold over the course of time. All right, let's move on to company-owned vehicles. You have to track the personal use of the vehicle if you're using a company-owned vehicle, or else the entirety of the value of the use of the vehicle is considered taxable income. So that's the stick approach if we're looking at carrots and sticks. If you don't track it, it's all going to be considered taxable income. But the most common method for evaluating what the use of the vehicle is the annual lease value method. Now, what is that and how does it work? Well, I'm glad you asked. Here's a little example on this slide. So first, you determine the fair market value of the vehicle when first made available to the employee, all right? And that is going to be the amount that you look at every year thereafter, okay? So that's important. And then use the IRS annual lease value table, which is located in IRS publication 15-B, page 29 in the 2026 edition. Figure the amount of personal use, so you literally just match up the value with the amount that's listed, on that table. You figure the amount of personal use, which means that you have to track the amount of personal use, and then you multiply the annual lease value by the percentage of personal use. Now, that's just a lot of words. Some of you guys, you speak in the language of the universal love language of accountants, which is numbers. So I'm going to give you some numeros. All right, here's an example. Let's say the vehicle's fair market value is $40,000. You looked at the annual lease value table, and it shows $10,750. And I can attest to the fact that those numbers are correct. And then you have tracked the personal use of the vehicle by the employee, and that personal use is 20%, which means that the annual value to the employee is $2,150 plus any other direct expenses that were paid by the employer. That is how you arrive at the actual amount that will need to be included on the employee's W-2 as taxable income to them for personal use of a company-owned vehicle. And with that, we are going to launch polling question number three. Number three. Which of the following is true with regard to reimbursement of car expenses? Number one, both commuting and transportation expenses are reimbursable on a non-taxable basis. Number two, the standard mileage reimbursement rate for business use of personal vehicle is set by statute at 14 cents per mile. Number three, substantiating and then providing documentation of actual expenses for business use of a personal vehicle is the predominant method used by employees. Holy smokes, who wrote these? And then number four, the annual lease value method requires that the employee track the personal use of an employer-provided vehicle. Now, remember, we're looking for the one that is true. The one that is true. Sorry that I had to get so tricky on these. You guys are doing great. Let me see here. Yeah, $75. Yep, it's $75 for those of you for those of you who are asking and telling about the $75. Yeah, secret's out. Evidently, the internet's not a fad. People are still using it, and they can get on there and find information. Man, but it's a bummer. It's a bummer. Okay, let's keep looking through these. Can we offer accountable plans for expense reimbursement for non-employees? You sure may. You sure may. Even volunteers. For non-employees, can we offer per diems through an accountable plan? That's right, per diems. That is a method that you can use. I don't go through per diems in this presentation, by the way. If you want to throw something in the chat that says, hey, Chris, I want to hear about per diems in a future presentation, just let me know. Happy to chat about per diems. Did legislative passage of last year's one big beautiful bill have any large direct impact changes on accountable reimbursement plans that are worth noting? Cliff, I don't think so. I don't think so. Do we have to follow the IRS rate? Good question, Claudia. The answer is you do not. You can do less. But if you do more, just know that you are in danger area. Okay. All right. Let's end this polling question. The correct answer was 4. 4. Good job, guys. The annual lease value method requires that the employee track the personal use of an employer-provided vehicle. That's absolutely right. You can't get out of tracking personal use of a company-provided vehicle. It's just baked into the pie. Okay, we're going to move on for sake of time. Spousal and dependent travel. Time flies when you're having fun. Expenses for spousal travel, they're not reimbursable on a pre-tax basis unless the spouse's presence is has a bona fide business purpose. Now, what does bona fide business purpose mean? Well, it means that their tasks are meaningful. They're not just tacked on. They're not nominal. They're meaningful. Now, I get it. Meaningful can sometimes be the eye of the beholder. So let's run through some other language that has been used in various IRS authorities. It's more than incidental. It's ordinary, necessary, directly attributable to the conduct of a trade or business. It's required or necessary. It's substantial. It's directly and primarily related. So you're hearing this language. It's been used in revenue rulings and other court cases. And you should be thinking to yourself, all right, so this should be pretty hefty. If that spouse / that dependent is going to have their travel expenditures paid for by the nonprofit, then their duties need to have some heft to them, need to be meaningful, substantial, directly attributable to the organization's needs. So what kind of examples don't cut it? Well, number one, typing notes. Bringing a spouse or dependent to take your notes is not going to work. Trust me, I've tried it. Brought my 5-year-old son to be my note taker to CP. I'm just kidding. That never happened. But bringing a dependent, bringing a spouse to just be a note taker, not going to cut the mustard. Number two, yes, your spouse, especially, and especially if you're in an outward-facing role, CEO, development director, that kind of role, having them present can be very nice at lunches and dinners, but just that purpose alone will also not cut the mustard. Which, by the way, I've never cut mustard. So I don't know where that phrase comes from. Maybe someone can throw that in the chat. That's not worthy of a Q&A. All right, that's very much a chat thing. And then the last one on this one is attending a conference to be present in a hospitality suite. That can be part of what they're there for, but by itself is not sufficient to say that that is meaningful or directly attributable or necessary. So what are some practice tips here? Well, you need to document the business purpose of the spouse or dependent if their travel is going to be paid for and if you want to exclude it from that employee's taxable income. Documentation, documentation, documentation. And then you'll want to reflect what that role looks like, what their responsibilities look like in some kind of contract or meeting minutes with the board. And then importantly, you'll want to consistently put this into practice consistently. Remember, we want to avoid a culture of good for thee and not for me. All right. So from CEO all the way down, anyone who wants to bring spouse dependent and wants that travel to be excluded from taxable income, there should be some documentation of that. And then the final various scenario that I'm going to explore is the personal versus business use, the mixed use situation. This pops up often. It can be tricky and nuanced. What if something that they purchased is able to be used outside of the employment context? This will sometimes pop up in ministries more particularly, but I also see it just generally, especially in the development space where, for instance, let's say that someone needs to get golf equipment in order to play golf. We know how often deals are done and hands are shaked, laughs are shared on the golf course. Actually, the only thing I share on the golf course is frustration and anger because I'm terrible at golf. But that's oftentimes a space where people can have a relationship. And in the development and fundraising space, that is key to the sustainability of an organization. So golf equipment, reimbursable on a pre-tax basis? Safety net here is you can reimburse and then include it in the employee's taxable income, but you'll want to inform them first before you do that, all right? So, inclusion in taxable income does cover over a multitude of sins with these kinds of situations. But I figured in order to provide just a little bit of help to you guys as you're navigating these situations, I thought I would provide a 2-question, well, maybe 4, depending on how you count them. I'm a lawyer, not an accountant. But a 2-question framework for how to think through these mixed use questions. All right. Number 1, are there any attributes or any authorities rather that have opined on this particular expense? So one that comes directly to mind is clothing. With clothing, that's not going to be a non-taxable reimbursement unless it fits into very tight restrictions on clothing. If so, follow the authority. That's pretty easy. You look to see whether the IRS or some other authority has spoken with an authoritative pronouncement on this. In the absence of that, if not, is it something that the organization can own and the employee use only when required for business use? So this is something that would be stored at the ministry, it'd be owned by the ministry, and then employees could use it when they need to. Then in that case, do that. And depending on the thing, you may or may not need to track the value of the personal use. Clearly, with company-owned vehicles, you have to track the value of the personal use, so there is tracking involved. But for some of these, it just wouldn't really be susceptible to that kind of personal use analysis. So that's my 2-question framework, my 2-question pathway, if you will. Is there a particular authority? If so, follow it. If not, is it something the organization can own and then the employee can use? When in doubt, include it in taxable income. All right. And I lied earlier. Many apologies. I'm a lawyer. It's part of the training, but I wanted to address food really quickly. It's a very common expense, especially for those executive and outward-facing positions. But there are lots of different elements of food that are not going to be includable in taxable income. So for instance, group meals where all the staff are getting together, that's going to be a de minimis fringe benefit, most likely. Coffee breaks, donuts, pizza, those kinds of items, just because it's going to be very difficult to assess the value to particular employees. What about meal money, though? What about giving an employee meal money? Well, that can be excluded if it's on an occasional basis, number 1, if it's provided for overtime work, number 2, and if it enables overtime work. So this is where meal money can be a thing. But what about situations that fall in the gap? What about meals for the convenience of the employer? Well, this is under Code Section 119. If the meal is provided on the employer's business premises and the meal is provided for the employer's convenience, which can mean either, you're on call for emergencies, so you can't break away and go to your local Chipotle or Qdoba. If you want to, just let me know if you're Team Qdoba or Team Chipotle, or maybe maybe your Team Taco Bell. I don't know. Who knows? If you know, you know. But yeah, is it because you can't break away? Is it because you can only have short lunch periods? Are there no eating facilities in the area? Like, you have to really do an assessment of whether this is truly for the employer's convenience. Okay. But if the meal is provided on the employer's premises and it's provided for the employer's convenience, then that can be excluded from taxable income. And so with that, we have 4 minutes remaining. And guess what? It's time for our fourth and final poll question, which is, all of the following are true, okay, with regard to reimbursing meals and food expenditures, except, so we're looking for the false one. Number one, meals provided for the convenience of the employer are excluded from the employee's gross income. Number two, meal money that is provided on an occasional basis and meets the other requirements is excluded from the employee's gross income. Number three, coffee and pizza provided on a group basis for employees must be included in the employee's gross income. And number four, meals and food are a common source of tricky reimbursement questions. All right, I'm going to take a look at some of these questions. There's a lot of questions. There's a lot of them. You're a curious bunch. I like it. Thank you, Sean. Chipotle all the way. I just had Chipotle yesterday. Solid performance. Okay, I'm going to look through these. Do you see more people using fleet vehicles or getting rid of fleets for mileage reimbursements? This is a question from Brandon. Brandon, it's hard to say. It's hard to say. I think that really depends on the nature of the organization and what that organization does. Do they have to utilize transportation for getting people to and from places? Or, is it, more of your standard run-of-the-mill office-based job? So I think it really depends. So sorry that I'm not really a great source of information there. I hate saying it depends. I really do. I say it a lot. Can we set the mileage reimbursement less than the IRS rate? Yes, Kalin, you can. Yes, you can. So anything non-employee that is not accountable rolls up into the year-end 1099 reporting TY. Well, TYSM. Yes, Kathy. That would be the case with that. Now, I say that with a little bit of an asterisk because there could be a situation where that person more correctly should be a W-2, depending. But generally speaking, there's going to be some kind of tax reporting if it's reimbursed on a non-accountable basis. Sean asks, what if both parents are employees so the children need to go on the trip? Man, Sean, I like where your head's at. The answer is doesn't matter. I get it. It doesn't seem fair. But unless those children themselves have some kind of meaningful, bona fide ministry purpose, then it's going to be taxable to the parents. All right, I'm going to end the poll. Here's what we got. The correct answer is 3. Coffee and pizza provided on a group basis for employees must be included in the employee's gross income. That is incorrect. That is a de minimis fringe benefit, and you guys killed it. 76% of people got that one right. And now I'm just going to end with a couple of practical steps to consider. Number one, refine your policy. If you don't have like preamble language related to how people should think about what to spend, you should include that. Like, treat these funds as your own dollars, or think about the donors who have made sacrifices to contribute these funds, something akin to that. Number two, refine your process. If there are gaps in the process, meaning that your CEO is giving it to a lower level employee or something like that, then maybe consider refining your process. Number three, publicize your policy. Maybe have a training on accountable expense reimbursement plans. Shoot, maybe think about having people watch this video. I don't know. My hope is that on a scale of boredom, that this is one that maybe you only fell asleep to twice over the course of the hour. And then last but not least, actually follow your policy. Actually do it. Yeah, that's one of those things that sometimes can go without saying, but I feel like I got to say it. So actually follow your policy. That is a really 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 good idea, to say the least. So I hope you enjoyed the presentation. Again, Chris Purnell, three jobs, not really just one, but three different things. Feel free to connect with us on Facebook, Twitter or X, YouTube, all of the things. We're not on TikTok yet, but if you want to see us on TikTok, we'll do our best to crank something out. I'm just kidding. I don't think our social media people want to do that. And then most importantly, thank you so much for your time and attention. It's been an honor and a privilege, and I look forward to seeing you again sometime in the future. Take care.